It is Tuesday evening, and this is Vetted VA Live, where we get together every week with a group of vetted pros on the real estate and mortgage side to discuss topics that are important to you as a veteran borrowing, buying in the current market. So if you have any questions, our primary purpose here is to get your questions answered live, just like you can out in the Vetted VA group. You can post a text answer and get a text question and get a text response back. This is just basically a live version of that where we can go through it. So if you're here, you found us, however you got to us, throw the question up in the comments section there, and we will absolutely get your questions answered. Anything mortgage or real estate related, VA or not, we will be happy to answer. Tonight, we are going to be talking about VA interest rate reduction loans. It's the VA streamlined refinance. We're going to talk about what they are, why they matter, and most importantly, how to do it right. We had a lot of problems. When I say we, the industry had a lot of problems with big call centers doing some things that were not great for veterans. So I think it was 2022. We had some pretty significant changes to what you can and can't do. We're going to go through that, and we're going to talk about doing an IRRRL the right way so that you're not just getting a lower interest rate, that you're improving your financial future. So I have a couple numbers here that I thought were kind of important to kick off our discussion. So unless you live under a rock, everyone knows that it's about mid-2022, we started seeing a big increase in interest rates. So from 22 through 2024, there were 2 million loans originated with rates between 6 and 6.5%. There were another 2 million between 6.625 and 7%, and another 2 million above 7%. So we're going to talk about where rates are for the best qualified VA borrowers now, but we're getting to the point where almost all of those folks, at least on government loans, VA and FHA, would be able to take advantage. So we're going to talk about where the market is going, but most importantly, as there are more opportunities for people to do VA IRRRLs, how do we structure it? What do you need to know? And all of the details. So with that, Rylan, why don't you kick us off and just explain in broad strokes what a VA IRRRL is?
Yeah. So in broad strokes, it's a refinance that is specifically designed to encourage veterans who have made on-time payments to lower their monthly payment. That's the broad stroke of it. It's not a vehicle designed to pull equity out of your house, and it's not a vehicle designed to manipulate the different terms of the loan outside of the intention of saving money. So there's a few ways that it can benefit veterans outside of that. IRRRLs are also used to transfer entitlement and ownership. If you say are getting a divorce, I believe the IRRRL vehicle is what the banks use to transfer that entitlement. But in general, if you make on-time payments and you meet some of the criteria that the VA has applied to this program, you can save a good chunk of money on your mortgage.
And that's basically the gist of it, right? The VA has guaranteed your loan, and they're saying with a minimum of information and data from you, we're going to allow you to roll down to a lower rate. So with that, Randy, what are some of those eligibility criteria? What do you have to meet to be IRRRL eligible?
Well, the biggest thing is the IRRRL has to be able to provide you with a better interest rate, primarily of at least half a point in rate, and it has to have the recoup of the cost within a 36-month time period. So it's not something that you can go and do very often, because they're going to let you only do it every roughly 7-8 months, and every time you do it, it has to provide that kind of benefit.
So that timeline's kind of important. So I skipped over it, but we know all of the things that led to higher interest rates. We had a period of really above trend inflation coming out of the pandemic. We had a lot of stimulus, we had supply chain issues, and it led to really, really high prices. At one point, inflation was measuring up in the 9s. Now we're getting really, really close to the Fed's preferred measure, PCE, core PCE, being close to 2%. We're in the mid 2s. We get that number later this week. Last month was a positive surprise. If we get another positive surprise, we could see another leg lower in interest rates from where we are right now. But when you're looking at that and we say rates have come down a bunch, we had government loans, FHA and VA were close to 7%. Many lenders were up into the low sevens, and now we're low sixes, high fives in certain scenarios. We've already seen a 1% move there. So if you're only able to do this every 7 months or so, we do need to think strategically about this. Do we want to lock in the savings today, or do we want to play the market and see what comes next? Jason, when you're talking to folks, veterans who've bought a home through you, bought in the last 2 years, they're at a significantly higher interest rate, and they're kind of thinking about that. When do I do this? So the benefit's there. I meet that 0.5% interest rate reduction requirement, but do I do it now or do I wait? I mean, some of the stuff you guys may have not heard, but we have an election coming later this year. And many borrowers, homeowners, home buyers, think that depending on what happens with that election, it's going to be massively better or massively worse for them. But with that, Jason, what are you doing in terms of advising your clients right now of how to manage that process?
One of the first things I'm going to ask them, especially if they're active duty, is what does your forecast look like? Are you currently, are you expected to move in the next year, 2 years, 3 years? Because I see a lot of veterans who do in an IRRRL, kind of actually during that 2019 to like 2020 era, there was a lot of veterans who were doing IRRRLs, kind of chasing that down to that 2.25% interest rate. But what happened is as they're doing this, the cost was getting added to their loan. They weren't paying for it. They're just rolling all the fees into the loan. And let's say they bought in 2018, they chased this interest rate down, and then all of a sudden we're PCSing in like 2020, and they come to me and say, "Hey, Jason, we're ready to sell." And I'm like, "Well, you're actually upside down, or you're not even going to break even. I can't sell your home because you're going to actually end up owing. We're going to have to either short sell or you need to rent it for a little bit because you've done so many IRRRLs. You actually owe more than what your original loan was." And in a case like that, so one of the first things I ask is, are you up for orders anytime soon? Are you gonna be able to see the advantage of the IRRRL before you decide to sell and move out? Because in that case, trying to save a few $100s a month, but paying all this up front is likely not worth it. Now, on the flip side, if they're like, "Hey, I'm going to rent that place out," then it's a different story, right? We can actually make a home, especially in San Diego, where homes don't cash flow on day one. We can get closer to a breaking even or a cash flowing situation. I think we had a veteran in the group my last duty day, so I think it was last Tuesday, who was looking at doing an IRRRL, and it was like $14,000. Outside of, hey, maybe you should get a few more people to look over your scenario. As she was asking, should I do it to save like 0.5%? And it's like, well, depends. Do you think, what does your crystal ball say? Are you expecting rates to go lower? Then maybe you should hold off. Do you think the election is going to cause your rates to go lower? Maybe hold off. Realize that it takes 210 days and 6 payments to get to that point so you can do it again. Plus you're rolling in that $14,000. Like, I like to just show them the numbers, show them the information, and allow them to make the decision. But ultimately, really kind of jog their memory and say, "Hey, are you leaving in a year? Because it's probably not worth it." But if this is your first home, or you have 6 years, then that's a different story.
It's funny. Go ahead, Randy.
Well, the one thing I wanted that he touched on that's really important is that the IRRRL is the only streamlined program that I know of that they can have already converted to a rental property and still benefit from it. And that's a real jewel of a fact to know that if you convert your PCSing from one station to another, you convert instead of sell, and you still have bonus entitlement. That's a different factor, but that product is still available to you after the fact if the rates get better and it makes sense to do it, and you're not hit for being an investment property. That's a big deal.
To touch on Randy's point, and I'm asking more so because I'm not entirely sure, but there's also not a rate adjuster for it being an investment property. So not only can you do it on an investment property with a VA loan, but you don't have a negative impact to your interest rate in the cost that a lot of other refinances, like if you refinance a conventional property as a primary or as an investment, the rates are dramatically different sometimes. So yeah, like I more so confirmation because I'm fairly new to the broker world. I haven't done any IRRRLs in the broker world in the past couple of years, so good to know.
That's a beautiful thing.
Jason said something that's really important. So when your loan is recorded, your deed of trust is a matter of public record, and they know it's a VA loan. So look, some of these changes and guidelines that we're going to talk about that were enacted in 2022, they make it so you can't be taken advantage of the way many of these big call centers are doing. But where I was going, your loan records whether you refinance or purchase, and now everyone knows that you have a VA loan. So when an opportunity arrives, your mailbox is going to be full of postcards, mailers telling you the craziest things that you will ever see. So I have a client that we closed at 6.75. I don't remember what it was. It was a little more than 10 months ago. It was a good rate at the time, not so great right now. But about 3 months ago, like right before he hit that 210-day waiting period, he calls me and goes, "Hey, I've got a bunch of these things in my inbox. They say I can do 5.75. And it was the same thing that Jason just said. I said, yeah, we can do 5.75, but it's going to be like an absurd cost. Like it's a big loan, not huge, but $600,000 loan. It says it'd be like $15,000 in costs. Like we wouldn't do that. You would do 6.25. That meets that 0.5% requirement and keeps you at like $2,000 of costs, where, you know, it's a sunk cost. Once we have it there, we can't get it back, but within a relatively short period of time, $600,000 loan at 0.5%, you're going to save that money back. But where I was going with that is what we used to have when it was the Wild West. There were call centers that this is all they did is churn VA borrowers. You would close your purchase. They would call you the day after and say, "Hey, you have a 5% 30-year fix. I can get you a 1.5%. They didn't say it's a 1-year ARM. They didn't say you're going to pay 3.5% points to get it. So this is where some of those guidelines in terms of eligibility come into play. So Ryland, when that borrower comes to you and we're talking whether it's $14,000 or $2,000, whether it's a 0.5% savings or 1.8% savings, what is the calculation that we as originators have to do to show the VA that this is a legitimate loan, that we're not just churning it?
Yeah. So I'm going to explain that. But in that line, I really like what Jason said earlier in that, are you going to see the benefit? You were talking about a lot of those flyers and the stuff that comes in the mail. And a lot of those guys are not asking that question up front. They're not saying like, hey, we're going to save you this money. But first, how much longer do you plan on keeping the property? Are you planning to sell in the next year or two? XYZ, right? Because once we do this calculation we're about to talk about, we want to apply it to their plans for the house. Because there's plenty of times where the client says, I am selling this place and getting out in 2 years. It's like, all right, we're not going to talk about a refinance unless I can make you break even in 1 to 1.5 years, maybe 2 at worst. But I want you to actually see some savings before you sell the house. Otherwise, you do all this work and you still maybe lose out on a couple $100. So the way that we calculate that, the high level view is cost divided by savings gives you time to recoup your investment in months. So that opportunity cost of how much are you going to spend or roll into your loan, which is still spending, divided by the savings gives you that time period, right? Now, the VA says that we do not need to include things like prepaids. So property taxes and insurance that are included in your mortgage payment. Sometimes we can transfer those to the new lender, or sometimes we're refinancing you with the same bank. So that escrow account just moves. But if we are moving your loan to a new bank and we have to reestablish that escrow account, you're going to get a refund from your current bank of whatever's in there, but we have to build the new account with the new bank. So it's going to look like closing costs. The VA says that does not compute or calculate into your time to recoup. Now, this is just a personal preference, and it's something that borrowers need to discuss with their loan officer, but the VA also says we don't need to calculate the VA funding fee in your recoup, which, if you're not exempt from the funding fee, is 0.5% of your loan amount. Personally, I build the funding fee into their recoup because at the end of the day, if we're having conversations around how much longer do you plan on keeping your house and are you actually going to see the benefit, the funding fee is a cost. It's a cost into their equity, right? Or cash out of pocket. I want them to know that's going to be recouped in their timeline. And the analogy I found is, maybe I'm old school, but you guys remember you used to be able to get a new phone from AT&T every 2 years, and they'd let you do it after 1 year. So before long, a couple years down the road, you have an AT&T contract commitment for like 8 years because you added 2 years every single year. So IRRRLs are kind of like that. When you're going to refinance and you have a 24-month recoup, well, if rates drop in 8 months and you refinance again with a 24-month recoup, you're now at a 4-year break-even period and you're only 8 months down the road, right? So that's another conversation I like to have with clients, where it's sometimes like, hey, we can save you this much money right now, or if we gamble, we might be able to save you a little bit more 3 months from now. And this is where being an expert and trusting your loan officer, watching these market reports and giving you the information so that you, the consumer, can make the best decision for yourself, comes into play. But it's not always just, hey, you can save $150. Want to do it? There's a lot more to it than that.
100%, a lot more to it, because we're talking about, we have a blanket rule that the VA has applied, both in terms of that timeline, that waiting timeline, the recoupment. But you just said, okay, the VA says we don't have to count this, but it's important what you said. To me, anything that's a hard cost of the loan that I'm not going to pay it unless I do the refinance, we should build that into it when we're advising the client, because it's to a certain degree, it's a vanity metric. One of the things I like to say is, like, if I call a borrower 6 weeks after we close and I say, hey, what's your interest rate? Rarely do they know. They know in the ballpark. It's 6.25, but it might be 6.5. It might be 6 1/8, and it will catch them. So, but when we're locking and when we're telling our neighbors at the barbecue this weekend, everybody wants the lowest interest rate. Well, vanity and ego can get you in trouble, because a salesperson can go, wow, I got this special. We can get you this really good interest rate. And maybe it makes sense. We were talking earlier, we all have access to a lender right now that, at a relatively small cost, they'll get you a very good rate. And you look at that and you go, you probably would bite and pay that, but you need to make sure that you're working with someone that is advising you on that process. So, Randy, in addition to the issue of the 36-month recoup of saving at least 0.5%, maybe just spell out in detail what that timeline looks like and how that timeline is measured. So let's say you are that person that you bought at 7.25. Today you could do a no cost at 6.25, and you go, I want to do that, but we're thinking, quite probably, no guarantee, that rates are going to be lower in 2 months, 6 months. How does that 7-month timeline come into being eligible today, but then also thinking about when you would be eligible again and how you might structure that loan for a client?
So the biggest thing is, and I don't have it right in front of me, but I think it's 210 days from the date that your first payment is due, is the timeline that you're dealing with. So it ends up being roughly 7 payments that you're going to have made as a rule of thumb. So when you're looking at that, obviously you can't do that again for another 8 months or 7 payments, and so you just need to make sure that you have a strong feel that there's not going to be a big market movement down during that next 8 months, so that you're not locked out of the opportunity to capitalize on the bigger movement down. And that's one of the biggest things that is very, very difficult, is that how do you know? I know that most all of us here subscribe to multiple rate mortgage service market, mortgage-backed securities, etc., that we read every morning, and that most of us are tuning in to Hammer, tuning in to MBS Live, or whatever the services that we have. And even with that, those guys don't always agree with each other. I mean, there's been some really big, well-known folks that said that certain dates were going to be when it was all going to be the right time, and it was kind of like the way back in 99 2000 that people thought the whole world was going to crash, and then nothing happened. And so it's just a difficult thing to know, and so you kind of have to think of it in, if I do this, is it going to be okay if I miss something that's a little bit better? And that's a difficult thing to know. You know, you just have to jump out in faith and make sure that this particular one makes sense to you, and that if it's saving you $350 a month, that you're going to be okay with that for indefinite amount of time, in the fact that you may be picking the right time. You don't know. So it's just difficult to absolutely use the crystal ball to say this is the exact right time. That's a challenge.
So overall, in terms of eligibility, we've covered a lot of stuff. Those rules in how much interest rate you have to save, how much you can spend, and how long you can recoup it, how often you can do this. Randy, you brought up a great point that doesn't need to be owner occupied. The property can be an investment property. One of the things we didn't talk about, are there credit score requirements? Do you have to have a certain credit score to be eligible, or what gets looked at in terms of the credit with the IRRRL?
No, I mean, it obviously, credit scores play into rates, in that they're another factor when it comes, because obviously you have your base market rate, whatever that is what it is. But that in the world of vetted VA loans, you're talking a 680 FICO score is basically the gold standard. If you're above that, you're just bragging. If you're below that in 20-point bands, it starts to make an impact. It really doesn't make a huge negative impact to the rate until you're under 620. But there's still folks that will go lower than that. I have 43 lenders, and I've got some that will go down to 500, but just a couple. So but the rates under 619 are going to be substantially higher than the market rate. So obviously, I'd love for you to have the best FICO score, 680 or above, when we come to this, so that you're not hurting yourself. Is that your question, Josh?
Yeah. And the credit score is always going to be important. And we go back to the issue, the VA guidelines don't say what it is, but in terms of the real world, investors, like I had one of my realtors ask me, you can do it without a score, right? And I go, I'm sure we could find an investor that might do it without a score if we can show, but if you have a mortgage and it has a mortgage rating, you're probably going to have a score. So it's unlikely to have someone coming across as no score. It's not as important here, but it will dictate kind of your terms that you're going to get. And one of the things that's kind of been interesting this go around for all of us in the business, we had a massive spike in the costs of credit reports. I've been surprised that some of our investors are taking soft credit pulls. We don't even have to have a hard credit pull. You can do a soft pull, no impact to your scores going forward, and we can use that for the score for eligibility. Not with all lenders, but with some lenders will allow that. So let's say we've gone through the process, you meet all of the criteria, you're thinking about it, it might make sense for you. Jason's walked you through that. You have a longer term time horizon. The recoupment is there. Jason, if you have someone who is at that point and they just want to know, well, how big of a deal is it? What's involved? What should they expect when going through the process with an IRRRL, and how does it vary from when they bought their home and you're getting income docs, bank statements, everything? Is it the same or is it any different?
It's pretty easy. I mean, it's kind of like calling up Randy or Ryan and saying, "Hey, I'm interested in an IRRRL." They're like, "Hey, let me. They're going to run your credit, and there's no appraisal involved. It's pretty streamlined. Fill out an app, and then 20 days later, I'm going to be signing some loan docs, and then I'm done, and nothing changes." Maybe except for where my mortgage went to.
You'll have to go through that process of setting up the portal again.
Yeah.
Sorry for the typing earlier. I was sharing to Facebook. Yeah, there's three main documents that I tell borrowers to kind of keep handy or have available when you start the IRRRL process. You'll want the most current version of your insurance binder because we want to reapply your current insurance policy to your new loan. We need a copy of your note. So if you did your initial loan with the loan officer you're going back to, they should have a copy. But if you're going to a loan officer that you didn't previously use, go through your closing documents. It says note at the top. It's about 3 pages long, and it has the details of your loan, what the initial balance was and your interest rate. It's required for underwriting, but it's really important to get those numbers really accurate to calculate your time to recoup and so on and so forth. And then finally, like you said, you want anything else that you might have attached to your house in the meantime. So if you got a solar loan or a HELOC since the last time you bought, we're going to need to subordinate that mortgage on the new loan. So having that paperwork, that documentation is really helpful if you have it up front. That loan officer, as Jason said, he or she is going to be able to process and handle mainly the paperwork side. There's not a lot the consumer needs to do in about 2 to 3 weeks, ideally. So.
From a cost perspective, Randy, how does this vary from that purchase transaction? You know, a lot of times people come in and say, I paid 2% in closing costs when I bought the home. Are these limited, significantly limited in terms of the costs relative to a purchase?
And I always tell people that probably you want to look at the hard costs. Like Rylan said earlier, there's going to be some juggling in the world of the escrow account that you're building versus the one that you've already got. So, you know, obviously different states have different escrow. The taxes are due at different times, and your escrow, depending on where you're at in relation to that, the more you're going to have to build. So, in other words, if your taxes are going to come out in November and you're doing a refinance in September, then you're going to have to build a pretty big escrow account. Now the balance to that is you're going to already have an escrow account that is fairly sizable because it's prepping for that November bill, and so your loan amount, depending on, like Rylan said, sometimes you can transfer that over to the new loan, sometimes you can't. But some people use it, especially in Texas, where you can't get cash out on a VA loan. They can kind of use it as a what I call a poor boy's cash out, in that if you've got $12,000 sitting in escrow and you're going to rebuild it in the new account, you're going to get it refunded to you from the current account, and so you're going to have $12,000. And if you time it right, you're going to not have to put a couple of payments out of your bank account into the deal. You're still putting those payments in there because it's being rolled into the loan itself, but it can be used as depending on the time of year that you do it. So obviously after the time when the escrow account is going to be the smallest is ideally the time if you're really wanting to keep your balance the lowest, like right after the taxes are paid, right after the homeowner's insurance is paid. That's the time to be able to strike if you're trying to get the lowest transfer of cost, etc. But again, those are just from one hand to the other. The hard cost itself is, I always say, about $3,500 here in Texas. You can get, depending on how long your title policy has been in effect, you can get some prorated charges for that here. And for the first couple of years, you're going to get a reduced amount there. But you're going to have to build a new escrow account, and that's the real cost. There's no appraisal, which that's $700 or $1,000 that you're not having to do. The title policy is really reduced, but you're still going to pay for another closing or escrow fee, whatever you call it in your state, the notary fee, whatever that might be called. You're going to have to pay for that. So typically it's about a $3,500 hard cost. When you cut through all of the balance, and is probably something that you have to look at. And then you're going to have, depending on what time of year and how far you're in the deal, you're going to have amortization changes to your note that you have to factor in as well. Because if you've been paying for 3 years, you're going back typically to a 30-year. You're going to lose some ground there. but oftentimes we don't really care so much about that. We care about the fact that it's $450 less a month that we're paying out. And then, like I said, sometimes we use it as a poor boy's cash out to get, 8, 9, 10, 12,000 in our pocket, to help us. And we can use that wisely to do other things. You might be able to pay off your car and take a $800 payment out of the mix with that poor boy's cash out. It's just, you got to be smart about it, but roughly 3,500 is the short answer. The long answer, obviously, is a little bit longer.
That's the key, is being smart, because those soft costs is really what's gonna, which depending on what kind of loan officer or lender you're working with, if they're not calculating like that funding fee or talking about those soft costs, that's what is going to get you, especially if you're an active duty military, shore duty for Navy personnel here in San Diego is 3 years. Back when appreciation was going up drastically, let's say 3 years, that was a that was a point where they could sell their home and maybe walk away with $10,000-$20,000, right? After fees and whatnot. And that's before the COVID craziness, right? So, but you got a funding fee because you're probably still active duty and no disability. So on a $500,000 purchase, you're looking at like $2,500. Taxes here in California are about 1.1, 1.2, depending on the county. So that's about $6,000. Split that in half because we pay it biannually, so $3,000. And then you have insurance. Insurance here is $3,500, $3,800 a year. So if you're getting that impound account, that the taxes and insurance sent back to you in a paycheck of, I don't know, 10 grand, something like that, depending on what time of the year, and then just rolling that new impound account into the loan, and you do your IRRRL 2 or 3 times trying to chase that lowest rate, but realize that, hey, I'm not planning on renting this home. I'm going to sell it at the end of my tour here. That's what will get you. And then throw in something crazy like a solar lease or solar loan or something like that, and you're headed for financial mess. And that's where you really need to have these conversations with your loan officer.
So in the short term, just to add to that real quick, so you have two kind of events that we're potentially getting refunds back or resetting the clock on, right? Your amortization. So you're going to have some savings naturally just by going back to a 30-year versus a 27 or 25, however long you've had your mortgage. And then you're potentially going to get these escrows refunded in terms of your property taxes and insurance sitting in that account. So the beauty of the IRRRL is it gives the consumer the option. And I think the loan officer being able to describe or explain these options is huge. If the client sees that 30-year, timer start over, the beauty of the IRRRL is, okay, well, Mr. Borrower, Mrs. Borrower, keep making the payments you've already had. Pretend like we're not saving you any money, and let me show you how much quicker with this refinance your new loan will be paid off. Don't save any money, just accelerate paying the mortgage down, right? The refinance still might make sense. Same thing with those impounds. If the client sees their balance going up because of the new loan, that's great. We're going to save you X many dollars a month. And as soon as you get that check, don't spend a penny of it. Put it right back into your loan balance. It's going to drop it right back down. Or keep it, like Randy said, use it smartly, invest it in something else, pay off a high interest auto loan. You have those choices through the IRRRL. And I think it's really part of the loan officer's job, because a lot of times clients don't fully understand the opportunity of a refi, and being able to show them, look, what's those books that you choose your path, choose your
adventure.
Choose your adventure. It's like, look, keep the money, go to Vegas. Don't recommend it. Take the money, put it back into your loan. Here's the benefits. Or take the money, pay off debt. Especially we're getting into the Christmas season in the next 6 months. Maybe, having a little bit more cash on hand for the family is what a consumer is going to benefit from the most. And just explaining all those options, I think, is really important.
Rylan, you kind of just already did this, but let's play a little game.
Mhm.
I'm gonna be call center loan officer, the guy who stuffed your mailbox full of postcards saying I can get you a 2% interest rate, not telling you you're going to pay 10 points to get it. But I'm going to tell you what that pitch is, and it's a pitch. They're not an advisor. They're not helping you financially. They want to close a loan and put that unit on the board. They have a very refined pitch. So I'm going to give you guys that. Those of you watching at home, so you'll know the line of, I was going to use a word that Chris would have got mad, but the line that your salespeople are going to give you. And then I would love to hear from Rylan and Randy. You guys take the professional mortgage advisor approach and how you go through this with a client. So I'm going to use an example of a guy I'm doing an IRRRL for right now. And if he had called back, it's actually the guy who said he could get 5.75 back when rates were in around 6.25. And the thing is, oh yeah, you're at 6.75. We get you 1% lower. So there's no reference to the cost, no reference to the points. So they're appealing to him, saying that he wants to get 1% lower. They're going to go, okay, and then we're going to do this. We're going to structure this. Ooh, I see in here you have $6,800 in your impound account. We're going to get that back. So we can just roll that into the new loan. So you're going to get $6,800. And depending on how you want to do this, we can set this up where you can have 2 months with no payment. Your payment's $4,500. So that's another $9,000. So I'm going to put 15 grand in your pocket. I'm going to lower you a full percent in interest. That sounds awesome, right? I just need a couple of items. So send me these over. So they give you the benefit, and you're like, oh, hell yeah, that sounds awesome. But they're not advising you. And let's say in that situation, if the guy had been 4 years into the loan, no mention that you're starting back over at 30 years. So Randy, when you're having that conversation with someone, that is an option. And the funny thing is, I do this. I do what you guys are going to do and kind of walk through of the pros and cons. And he chose with eyes wide open. He didn't choose to buy that rate down to 5.75, but he looked at it and he goes, yeah, I'm cool with that. I'm cool with the higher loan amount, lower monthly savings, because it ended up, we skipped one payment, $4,500, and he got about $6,500, about $11,000 he put in his pocket. But eyes wide open, he knew that he was going to have a $70 higher monthly payment by doing that. So Randy, when you're having that conversation with a client, there's a lot of moving parts here. We talk about the prepaid interest, the actual prepaids, whether we're paying points, whether we're starting back over a new loan. How do you present that? How do you make that as simple so we don't get into this paradox of choice of giving the borrower 87 examples of what they can do? How do you simplify that so they can make the best decision for themselves, knowing all their options versus being sold something?
Well, I mean, the first thing I normally do is when I'm up against something like that is just show them an apples to apples, because typically my rate's going to be a lot better than those people to begin with. And so that an apples to apples may cut out a good portion of those discount points to begin with. And that is really, really important, because you need to focus not just what that rate is, but what the cost is. And here's all the costs that you have. And the costs that Rylan just went through of starting over, of, et cetera, the ones that we just mentioned, those are actually costs. And so the big question is, if you're putting, I think you said $11,000 in the guy's pocket, just tell him, here, yeah, it's costing you this, what they are, but what are you going to do with that 11,000? And so that's the benefit that you have to delineate. That the worst case in the world, and the reason probably that the laws changed to protect folks, is they weren't doing anything with that 11,000. They were doing the Vegas option, and they weren't, they were not bettering themselves financially by making this thing really be a tool as opposed to a vacation.
Rylan, does that mesh with how you go through with a client, or any other thoughts in terms of how you present it?
Yeah. So, to give my quick spiel, one of the first things I do ask up front is, what are your plans for the property? I want to know what their best case timeline is, right? Because if they say like, oh yeah, we're getting ready to move in 6 months, it's like, hey, you're solid. Don't even talk to me. If those plans change, hit me up and let me know. So I established a timeline that gives me an idea of what I'm aiming for. As we discussed, VA has a 36-month recoup. Ideally, I want to see my clients hitting 24 months or less, just because, especially in a downward trending market like we seem to be right now, the statistical chance of us having another refinance opportunity in the next 2 years or 3 years is higher rather than lower. And so a 36-month recoup is going to set you up for kind of FOMO potentially, right? Where we refinance and you're not even breaking even for 3 years. So if we refinance you again, so I'm kind of looking at that. But yeah, I might be a little bit more conservative than a lot of people. I like to compare the interest rate on the original loan balance, because it's kind of cheating to show someone their savings based on that amortization move, where even if I wasn't saving you any money or moving your interest rate, right, you're going to have a lower payment if we re-amortize. It's just like recasting to a point. So I actually base it on the original loan amount, the original interest rate, and I show them pure interest savings is going to be this much. And then we go into the kind of what ifs. So I won't repeat everything Randy just said, but the other aspect that I'm a stickler for words, I don't like saying skip payments. I like saying deferred payments, because you're going to pay interest every single day you have a mortgage, and you have a mortgage with your current interest rate up until the day it's paid off. And then you have a mortgage at the new interest rate. So first and foremost, if we're refinancing, we want to close as fast as possible to start the daily interest at the lower rate as fast as possible. And then comes the conversation of those payments, right? So mortgages are due on the 1st of every month and late by the 15th, but they're not late on your credit report until the 30th. So no matter what time of the month we're closing in, if we're going into this with a strategy, I spend a little bit of time up front discussing with my client when we expect to be able to close. And in that month, even if we're going to close after the 15th of the month, if they want to defer that payment into their future loan amount and keep that cash of that payment on the 1st, the way I explain it is, hey, we're going to roll in an extra $100, $150 of a late fee into paying off your current loan. But that's going to allow you to not be required to make the payment this month that we're closing. If we're funding the loan in that first 15 days, that's an irrelevant conversation, but I explain that. And then that's what leads you to be able to have 2 months of payments kept in your bank account. And the trade-off is, like you mentioned, a slightly less savings. Maybe it's $20 less a month by deferring those 2 payments, right? But it's just giving the client that option. We're saving you $400 a month. If you make your payment this month, we're going to save you $380 a month if you defer your payment the month we close. Let them have that option. That's the only other thing that I think I might do a little differently than others, is just explaining that.
One other big thing that comes into play on that is just from the beginning, I always tell people, we're going to try to do this where that it all works out, where that you cut the 2 payments or whatever. Don't spend your mortgage payment until the loan funds. Don't spend your mortgage payment.
Did you have to learn that one the hard way, that was something you needed to advise your clients to do, Randy?
Every time I advise that, because I've been bit in the butt, but where that for whatever reason, the title issue or something came up, and these people were counting on not making that payment, and they didn't have it because they'd already spent it for something else, and it bit them in the butt. So my first proviso is, we're going to try to do it this way, but don't spend it. Set it aside. Once this loan funds, you can go do whatever you want with it. Don't do it until then.
I'm going to take that one step further. Whether or not you're working with a vetted VA loan officer or any other loan officer, if you're a client, a consumer watching this video, and you are working that strategy of not making the mortgage payment the month that you want to close, set a reminder, a calendar, an alarm for the 27th of the month or the last Thursday of the month, and make your payment no matter what your loan officer tells you. I don't care if they swear they're going to pay the loan off or whatnot. Do not risk a late mortgage payment. Initiate the payment, call it in over the phone, 27th, 28th of the month. Don't let a weekend and the banks being closed cause your mortgage payment to roll over late. I would highly recommend 27th, 28th of the month. Call that payment in, make sure they timestamp it, and go from there. It might cost you a couple extra days. It's a refinance. There's no seller that's going to cancel on you. It's much better be safe than sorry in that regard.
You know, while you guys were talking, a couple things jumped out at me. Just red flags in terms of who you're dealing with. If you're dealing with a vetted pro, if you're not dealing with someone here in the vetted group, there are lots of good loan officers that are not a member of the group. But if you respond to one of these mailers, if you respond to a billboard, a Super Bowl ad, any of those things, if someone says anything about skip 2 payments, that's a pitch. That's someone that is selling you, not advising you. If you only get one option, here's the option, this is what it looks like, or the only 2 options are here with 2 points, I can get you this, or with 1 point or 0 points, I can get you this, but it's just one structure. Because I think you guys just heard there's a bunch of decisions that we have to make. You're always going to have 1 month where there's no payment. You're going to pay that interest. Do you want to stretch that to 2? Do you have the money to bring in to reestablish the impounds? I was telling you guys, I've got a lady here in Southern California, $865,000 loan. And where we are in California, I think there's like $9,000 in her impound. So I just asked her, I go, are you cool with that? I said, you tell me you want the lowest payment, so you don't want to add anything to the loan. And she's like, she looks at her checking account. She goes, yeah, I can bring in 9. She goes, you said I'm just going to get this refunded back, right? Yep, you're going to get that refunded back. She was cool with that. So there's like 4 or 5 pretty big decisions that your advisor, not your salesperson, should be going through with you to help you figure out the best structure for you. And then also just see what that looks like compared to another. You know, one of the best, really simple loan presentation spreadsheets. Another member here, Brendan McKay, he has one of the coolest ones I've ever seen because it has 3 options. It has you bringing in the costs, it has you rolling them into the loan, and then it also has you keeping the same amortization. Those 3 options. So you see, we're not starting over. Even if you're comfortable starting over, you can see with that comparison of those 3 options how much of that savings isn't really savings. It's just stretching back out to 30 years. And eyes wide open, if you look at that and go, I'm cool with that, that's great. But there are very few loan officers that are going to give you that insight and that knowledge for you to make an eyes wide open decision. So along those lines, Jason, anything that you feel like we haven't covered that a veteran considering an IRRRL should be thinking of if they're going through this process, or just looking at rates and seeing, you know, it's hard to get out of your Google feed and not see 14 articles trying to push a refinance on you at this point? Well,
one of the things that kind of caught my eye was because the IRRRL does not require an appraisal. In a situation where you have purchased a home in the last couple years, our market hasn't been going up. We haven't seen the appreciation like we did during COVID. And certainly not even, I think it's actually less, at least in my area, than it was pre-COVID. You might be in a situation, especially in a 0 down loan, in a VA loan, where you may not have really made any appreciation, or you might be in a situation where you would even be upside down in your home. But with an IRRRL, you can still do an IRRRL. So, if interest rates do drop, even if you owed more than what the house would sell for, you can still do an IRRRL, which is a huge advantage, because in a conventional or FHA loan, that is not an option. I mean, that's kind of what happened to a lot of those people that got sold those crazy loans in 2008. It was like interest only. Hey, don't worry, you can refinance, except for then their homes were upside down. And then they never had that option to get out of that crazy loan. And then their next choice was, foreclosure or short sale type deal. So huge advantage from a VA loan standpoint, that if you happen to be upside down, you still can, get that lower interest rate.
Absolutely.
I've got 2 rare occurrences and then 1 warning that I remembered as you were discussing. So employment and appraisal. So the VA does not have an income calculation, but typically the lender will still verify if you are employed or not. So that's something. Don't quit your job during an IRRRL, just like don't quit your job during a purchase, it's not always going to be brought up. It's probably underwriter discretion, but because IRRRLs are manual approvals, but it's something to discuss with your loan officer so that they can kind of strategize that in that processing paperwork side. If you're retirement age and your employment is retired, it's generally accepted. Just a little tip. As far as the appraisal goes, it's super rare, but the banks do an estimated valuation on the back end. And from time to time, that valuation has been off so far that the bank may ask for an appraisal or so on and so forth. So just keep that in mind. If it does come up, discuss with your loan officer, see what the options are. But I think I've seen that flag get raised once or twice in my career. And that warning, so a pet peeve of mine on those mailers of the salesman, not your advisors, your VA IRRRL benefit is never going to expire. You do not need to act now or call in the next 14 days. This is not a benefit that expires or is on a timeline. So if you see something like that on a mailer, that's even more of a red flag to buyer beware, I think.
I would add to Rylan and just say that anytime you get anything in the mail or a phone call, throw it to the trash can, hang up on the person. And if you think that they've jogged your memory to say, hey, I might be interested in an IRRRL, call up your original loan officer, call up a vetted VA loan officer, call up someone that you've been working with, or start to search out someone that you want to work with. And talk to some legitimate people instead of going down that crazy hole because they're likely not to lead you to a very successful route.
Your brain surgeon is not sending out mailers.
That is a good point. We actually, one of last week's guests, Jerry Avila, actually had a really good question. And I think, Randy, you covered this a little bit, but let's go in a little bit more detail. Just mentioned, can the veteran transfer any of the escrows from the current loan to the new IRRRL? So in some instances, this is possible, and it can eliminate that need of either fronting the cash or adding it into your loan amount. But Randy, how does that work? In what situations would it be possible?
Well, for the most part, it has, in my world, it has to be someone that is working with, where that I've got the option to place that loan with the current servicer in order to do that. I'm not aware of a lot of people that are a lot of lenders that are going to allow that if they're not the one servicing, just because they don't have the money. So, short and simple, there's going to be some opportunities if your loan officer has but even with servicers, they don't offer it either. It's just going to be more of a unicorn type situation in my experience, at least.
Yeah, I would say let's go back to 2020 and 2021 when we're doing tons of these. Way less than 10%. I don't know if the number was 2%, but it was less than 10%. Even though a lot of those people, we did the loan for them in 2019, rates drop a ton in 2020 and they're back. It's rare that it's the same lender that has the best terms. So if it's a quarter point difference and you have a $500,000 loan, is it worth $1,200 to go back to the place that's going to transfer over $2,500 for you? Maybe, maybe not. It's a great question to ask if you're interested. If you have a concern, your loan officer can go through that with you if it's even a possibility at all. I think we've done a pretty good job of covering this. Hopefully, if you've been here for an hour, you are now an expert in VA IRRRLs, and you know what your loan officer should be going through with you, how they should be presenting these options to you. And the most important thing is, again, when you're dealing with an advisor, what are they there to do? They are there to give you the information you need to make the optimal decision for you. Rylan doesn't make the decision for you. Randy doesn't make the decision. Jason, Josh, it's here are all of your options. Here's the pros and cons of each. Which decision is right for you and your family? So hopefully you're working with pros that are capable of doing that. If you're not, if you want a second opinion, if you want to start with a pro, go out to the map at vettedva.com. We have mortgage experts that can help in all 50 states, help you no matter where you're at. We have real estate professionals in most locations. Sometimes people get hung up and they say, hey, you don't have a realtor in my town. And real estate is absolutely local. So if we have one realtor in your state and they're way on the other side of the state, just give them a call. I will bet you that they have a realtor that they can refer you to with VA experience in your area. We've done entire episodes on why it is important to work with both a realtor and a lending professional that have deep experience with your VA benefit and how to maximize it. So again, gentlemen, I appreciate you being here, sharing your knowledge and expertise. We will be back next Tuesday with another group to go through another topic of importance to you. Have a great week, everybody. We'll talk to you soon.